Okay, hello and welcome to our audience members joining us from across the globe. I'm Raymond Karam, the Chief Program and Development Officer here at the Arab Gulf States Institute. We're taking a deep dive into the world of energy today and are grateful to have a wonderful panel of experts to guide us through these developments. I'll introduce our panel briefly here and share links to their full bios in the chat. A big welcome to Carole Nakhle. She is a globally recognized energy expert and thought leader with nearly 3 decades of experience spanning energy policy, markets, governance, fiscal regimes, and energy security. She is the founder and CEO of Crystol Energy, an independent award-winning advisory firm recognized for its strategic insights across the energy value chain. We're also delighted to welcome back Aldo Flores. He is a policy maker and international affairs specialist with a long experience in energy and foreign policy. He was Undersecretary of Energy for Hydrocarbons in Mexico's Secretariat of Energy from 2016 to 2018, where he led the implementation of historic oil and gas market reforms. He served as a Secretary General of the International Energy Forum from 2012 to 2016, based in Saudi Arabia. Last but not least is Harry Tchilinguirian. Harry is a widely recognized authority in global oil market analysis with a career spanning senior leadership roles across physical trading, investment banking, and international energy institutions. He has held multiple managing director and head of research positions, most recently at Onyx Capital Group in London, where he played a key role in shaping energy market intelligence and analytical strategy. Moderating this session and the person who brought us all together here today is my colleague Kate Dourian. Kate is a non-resident fellow at AGSI, a contributing editor at MEES, and a fellow at the Energy Institute. Previously, she was the regional manager for the Middle East and Gulf states at the World Energy Council, as well as the program officer for the Middle East and North Africa at the International Energy Agency. And with that, Kate, over to you.
Thank you, Raymond. Well, hello and welcome, everybody. Thanks for joining us for this quick look at what's happening in the global energy market, from oil to LNG to geopolitics, policy shifts, what it means particularly for the Middle East and Gulf producers. And I've just heard, I just had an alert saying that Saudi Arabia, the first day of Ramadan is tomorrow. So wishing all our colleagues in the Gulf and the Muslim world a very peaceful Ramadan, we hope. So just to set the frame, we're in a market now where headlines are driving prices day to day. I mean, we've seen more volatility, I think, than we've seen in sort of the final days of last year. And the big story, I suppose, is the sort of geopolitical risk, but what many see as a well-supplied market. So basically, what is driving this market, the energy market? We're talking oil and gas, and is it geopolitics, is it fundamentals, or is it policy? So maybe we'll start with Carole. Where do you see things? What are you looking at the moment as to what is driving this market?
Thanks, Kate. Well, it all depends on the kind of time frame you want to focus on, because if you're looking at the very short term, day-to-day changes in prices, let me focus more on oil because with gas it's a bit of a different story. Then definitely I would say the main driver since the beginning of this year has been definitely geopolitics, the fear of supply disruptions, all sorts of scenarios that you can envisage. Because remember, on the very beginning, the first few days of this year, we had what happened in Venezuela was the removal of former President Maduro. Then we have the tensions and the other issues in the Middle East, and also ongoing issues in Ukraine. So actually, if you look at the map, wherever you look, you see kind of tensions boiling, what I call tensions without borders. So everywhere in key oil and gas producing countries and exporting regions. Because so that's for me is the main driver: geopolitical tensions, geopolitical risks, geopolitical unknowns that can result in all sorts of scenarios. And that's why you see the prices, daily prices reacting to news, headline news. But if you strip that from the trends or the market reality, it continues to be, as it has always been, demand and supply. So on the fundamental side, on the supply and demand, we have not seen any drastic changes, maybe some small disruptions, let's say in Central Asia and Kazakhstan or elsewhere, but nothing really that changes the course of all the forecasts for this year on the fundamentals for demand and supply. And that's why I think if you remove the geopolitical tensions on the side, you will see that the picture is not very different from what it was last year. The demand is growing, but not really booming, but supply is still growing at a faster rate from the usual suspects as before.
Mhm.
So in that respect, we see if you look at the forecast for oil prices this year, funny enough, none has been revised drastically, and they continue to be actually between 50 to, I would say, mid 60s. So this is the kind of picture that we have at the moment, fundamentals versus geopolitics.
I'm going to go to Harry next because Harry, you look at these sort of supply demand fundamentals and balances. So where are you seeing the market? I mean, do you agree with the IEA? I mean, both of us are familiar with the inner workings of the IEA. You've worked on the oil market reports, and they still see a huge surplus this year, even though they also say that there are some missing barrels from last year. We were all at IE week I think it was last week. The mind boggles, and I heard Vitol, the CEO of Vitol, saying there's about 50 million barrels on the water. So where are your calculations when it comes to supply demand fundamentals at the moment?
Well, that's an excellent question, Kate. So, hello, everybody. And I'm going to pick up a little bit on what Carole said. Yes, very short term, we have geopolitics that trump, no pun intended there, the fundamentals. And I think what is most interesting, and perhaps at IE Week, what was often very overlooked, is that people look at a headline number in terms of the global oil balance. Unfortunately, the devil is in the detail and its components, and you have mentioned a couple of these. What looks like a very bearish headline, in fact, hides a more fundamental truth, one that is really related to the availability of oil that has been stored away. So, first, large amounts of oil have been squirreled away in China into strategic storage, filling up new refinery capacity and lines. This oil is not available to the market. That's number one. Number two, I guess more importantly, is that the bulge in floating storage that everyone is talking about. And here I distinguish floating storage from oil in transit, which is oil that has an actual discharge destination. So the build in floating oil that we have witnessed is, for the most part, sanctioned oil. So without the two usual suspects that buy the sanctioned oil, which are India and China, that oil is effectively off the market. Even more so now that India appears to be willing to placate a little bit Donald Trump and is looking for barrels elsewhere. So what does that mean? That means that we have a much tighter situation. Commercial inventories in the OECD, which hold the pricing centers of oil, well, they're low. So it's not surprising when you have the temporary supply outages that were mentioned earlier, or have geopolitical development that the market reacts in an upwardly manner. Look at the market price structure, it's in backwardation, typically signaling scarcity. And when you look at what China has been doing effectively by putting oil into storage, we have essentially have a countervailing mechanism to increase production from the likes of OPEC reinstating oil or strong supply growth. So in effect, at the end of the day, that backwardation in the curve, a desire to hold physical inventory, like famous convenience yield of these of storage, well, all that essentially shapes why you could have a upside to market when the kind of things that Carole was touching on actually happen.
Yeah, because I mean, having covered OPEC for a long time, I know that they do look at inventories. I mean, price, they can manage supply, but they do look at inventories sometimes even more than price. So we started the year talking about, well, the impact of tariffs. I don't think we're talking about tariffs at the moment because they go up one day, they go down the next day. Then it was Greenland, it was Venezuela at the start of the year. Now it's Iran. I mean, we're not really talking much about Venezuela and what's happening in that part of the world. So Aldo, you're sitting in Mexico and you've been watching what's going on. You know, Cuba's in trouble because Mexico's not exporting anymore. Well, it's not supposed to export anymore. I mean, Trump seems to be getting his way. The Indians are seizing tankers. They're not buying as much Russian oil. So what is happening in your part of the world?
Wow, a lot and a little at the same time. But let me just add a little bit before to what Harry and Carole were saying. I agree overall with them. I mean, definitely in the end, it's supply and demand fundamentals that make the difference. And yet, those two are being quite affected by policy decisions and geopolitical developments that are today underway. This is where Venezuela comes into the picture. But this is also what we've been seeing in terms of the pricing of various energy products, at least since the invasion of Ukraine. But I would go even back with the spikes in energy prices in Europe and in Texas because of climate change or cold weather or whatever that was. So anyway, the last that I mentioned are more about fundamentals, and those we do see more long-term sustainability of the price disruption. The other ones are still indeed in general more temporary, but I'm seeing something a little bit different here with the Venezuela story, which is geopolitical, and partly with what is going in also in North America and the Americas in general. So the first thing I would say about Venezuela is that nothing yet has changed, right? It is so we now have a more open regime, but it is more open not because a decision made entirely by the Venezuelans, not that they wouldn't like it to be. That's a different discussion. It's open because a military operation that the US held, and one can only wonder how sustainable those regimes are. If there is no ratification on the part of the Venezuelans about this change, and by ratification I mean a decision that is clearly seen as Venezuelan made to be sustained for the long term, then we are still going to be in an environment of uncertainty. And Venezuela has a lot of homework to do before making its oil industry, let's say, boom again, or having it recuperate the levels of production that it had. The Venezuelan story right now about oil production involves institutional reform and a whole set of changes that are required to reduce the risk of investing in Venezuela, as much as there is a lot of enthusiasm there. So that's one part of the story. But anyway, I can talk about the other countries in the region, but I know we'll have a longer conversation here, so I don't want to use too much of my time at this stage.
No, but I mean, yeah, but sort of going back to the whole situation with supply. I mean, Mexico, you've had problems in Mexico with declining production. You're sort of part of the OPEC plus, but you're not really, because it doesn't really apply to you. You're more observers and can influence. But at the moment, I mean, I see that the United States, with Venezuelan oil that they're marketing, with their own oil, with other sort of related producers in that part of the world, they have quite a lot of control over the market supply, and they're using it as not just oil but gas as well. And one of the questions that came out is, I mean, how do you, amid all this uncertainty, we don't know what's going to happen. The Iranians today are holding, the IRGC is holding maneuvers in the Strait of Hormuz at the same time as we have these talks in Geneva on trying to get to peace, nuclear agreement. Iran insists on nuclear agreement. And knowing the Iranians, and I remember talking to an oil executive who used to have a interest in Iran. He says, negotiations with the Iranians are interminable. Just when you think you're going one step forward, you go two steps back. So is this sort of, is what is happening now in the Middle East, in the Strait of Hormuz, a real risk of a supply disruption, not just to oil, but, particularly also LNG, because Qatar has no other outlet? Is that something, Carole, that we should be looking at seriously? And is that one of the reasons why there's a lot of, if you look at the market players are now I think there's a sort of more bullish sentiments on the buyer's side at the moment.
Kate, absolutely. I mean, what is happening in the Middle East, and particularly between the Americans and the Iranians, is kind of show of strength, who is bringing more power to the table, is keeping the market pretty nervous, because Iran, even though I personally believe it has been significantly weakened compared to, say, a year or two ago, partly because its proxies in the regions have been weakened, Bashar, one of its close allies, Bashar al-Assad, gone. It was attacked directly by Israel, but also the Americans attacked its nuclear facilities. So, in a sense, that Iran is not the same power as it used to be, but it's still an important player. And what they did just today, before actually you went live on this show, like closing parts of the Straits of Hormuz, for me, I think it's quite symbolic because they are in the middle of negotiations, and it's important when you go into such negotiations to go with a position of strength and not from a position of weakness. But it's still a show, a display of what they could do in terms of disruptions to the Straits of Hormuz. But they only closed some parts of it, or announced they were closing it, and only for maybe a couple of hours. So that risk is there, and that's why you see this kind of upward pressure on oil prices, and also it's affecting LNG to a certain extent, as you said, because it's also an important trade route for global LNG trade. I mean, if you look at, let me think about it differently a bit. If you look at the previous instances involving Iran, in the last few years, we saw prices spiking a bit, but then correcting themselves. So I feel that the same risk premium for that we used to assign to geopolitics kind of weakened compared to a few years ago, simply because the nature of global oil markets has changed significantly with the advent of shale. And yes, I hear what Harry said about some oil not being available, sanctioned oil, but guess what? Sanctioned oil will always find a way in the market. So today, if assuming under the worst case scenario, the negotiations between the US and Iran collapse and the situation escalate, yes, we should expect to see disruptions to supply, perhaps, or maybe fear of those disruptions that will result into higher prices. But I doubt we're going to stay in that high price environment for too long. Sooner or later, the market will readjust. And also, really, if you think about what could happen to Iran if the negotiations fall apart, you have endless scenarios. It's not going to be just a change in regime. I don't know how bad the situation is going to be. I don't know how smooth the transition is going to be in Iran. So there are all sorts of scenarios that would expect there. But at the moment, we keep our expectations positive that maybe at the end, because Iran is not the same as it used to be, maybe a deal will be reached. But then again, raises lots of questions about what a deal could mean to oil prices as well.
Yeah, it could be probably similar to the deal that was scrapped in 2018, and then let's not forget there's another player that is also watching these talks, and they want the ballistic missiles included, which Iran doesn't want included, the proxies. But you mentioned Bashar al-Assad, and I just thought I'd throw this in because I read it today. Apparently, during the 12-day war with Iran, he was playing Candy Crush. I mean, it's just, I think it was in the Atlantic. But anyway, that's an aside. But I just thought I'd lighten things up a bit. So we've had a question, and we were all at IE Week, International Energy Week, in London, and I was on a panel where the talk was supposed to be about the Gulf and but we were talking China. Most of the talk was about China. China was basically holding up the market in many ways. They were also, supporting Russia and Iran by buying their oil. So how important is China to the sort of the global on the demand side, particularly as they have options. They are growing their renewables capacity. They're also, switching from gas to renewables for their heavy trucking. So, have we seen a peak in some of the demand for certain products in China? Harry, have you looked at it? And they're also building more storage. So why are they building so much storage for oil storage if they're sort of slowly moving away from hydrocarbons?
Well, Kate, basically, I mean, coming back to the idea of what does China represent in the current market circumstances, as I said before, one of the reasons the market is holding up, and you do have scarcity as reflected in the pricing of oil markets, backwardation, not just in dated Brent swaps, but Dubai swaps as well. China is basically a massive taker of oil going into strategic storage, right? And that's oil off the market. Now, if you think about Asia in general and the concerns over security of supply, And we come to this concept of what's called the convenience yield. It is that return that you have that's non-financial for actually holding the physical commodity with you, right? And if you have all these question marks around the potential for supply disruptions as events unfold in the Middle East, we don't know exactly which way the US-Iran talks are going to go, which outcomes there will be. Will there be strikes? Will these be limited in their scope, etc. You guys, as you know, Carole was saying, there's plenty of possibilities here. But China still is an engine of oil demand growth, and it's being caught up, of course, with by other countries such as India and the rest of Southeast Asia, and it still remains one of the key drivers. And irrespective of whose oil demand forecast you're going to take, and I don't want to quibble over numbers here, but the general narrative and direction is that Asia is the region, including China, of course, that will drive global oil demand growth. Now, whether Chinese gasoline demand is going to grow a little less because they have strong EV penetration, thanks to a whole surplus of vehicles, essentially resulting from government policy actions to subsidize that sector. Well, yeah, okay, maybe. But we're looking at naphtha, we're looking at petrochemical demand still being strong. That's where capacity has been added. And at the end of the day, if you look at China economically, you were mentioning these tariffs have been imposed on China, and you look at China's trade surplus, they have rerouted a lot of their exports elsewhere. So less going to the US, more going. So the primary engine of economic growth is still there. And naturally, you also have India, who's there to come as a relay and reinforce that demand. Against this, you have growth in non-OPEC supply, as has been mentioned, and we're now looking at a picture in the U.S. shale patch, which is probably one more of stagnation over the next couple of years. And the baton, if you will, is going to be passed on to other players in the Americas. So we're looking at Brazil, we're looking at Guyana, we're looking at Argentina. This is where literally the growth is concentrated and is coming from. And the arbitrage from west to east of these barrels is going to be paramount in terms of how overall regional pricing is going to shape out.
Thanks. Aldo, so a lot of the growth is going to come from your part of the world, a bit of stagnation in the US. I think we saw the impact on the market when you had that deep freeze, both on oil and gas. But where do you actually think it's realistic to see any addition from Venezuela? I mean, I don't see the majors rushing into Venezuela at this point. How much growth can we really expect, and how is it going to impact? And what is the role? Venezuela is one of the founding members of OPEC. So now that they are basically their energy sector, their oil is under US control, how does that impact the dynamic? I mean, you know that because you've been, you were head of the producer consumer dialogue at the IEF.
A few observations. Well, first, I mean, what do we mean when we say that Venezuela will or can increase and when its production? I mean, if we are suggesting that Venezuela can go back to its peak production, that means increasing its output close to 3 million barrels per day. It won't happen in 1, 2, or 3 years, and that or even more, and that requires some credibility about the investment regime in Venezuela. And that means, as I said, that the rules, the institutions, the regulations, the procedures are in place for oil production to increase steadily. It's too early to tell if such a thing is going to happen. And as I mentioned, without domestic political support, it's difficult to see how any regime, investment regime, will be sustainable. So I think the jury's still out on what will be the Venezuela story. I do believe that this does mark a definitive shift in the way Venezuela is handling its oil resources and possibly managing its own company. But whatever that shift means, we have yet to see, and it's going to take a while for it to get to a situation in which Venezuela can increase substantially its production. We can see increases in production from Guyana, from Argentina. We can expect about the same from the US and Canada. Maybe Suriname at some point will be adding. But the broader picture that I would like to underscore, and this is to respond or to add to what Harry has been saying about the structure of market prices. I mean, backwardation also means that the market expects lower prices in the future. And that means the market is seeing a well-supplied situation in what I don't know what's the framework or the range that Harry's looking at, but let's say in 1 year. So that means that all these projections about a very significant cushion for the market, supply cushion, they are affecting the way market prices are responding to risk today. Let me say it this way. Yes, we're seeing geopolitical risk affecting prices or making them a little bit higher than they would otherwise be, but not significantly higher because none of them imply yet supply disruptions that would affect in any significant way the balance in the future. I'm reminded of what happened when what was the name? Ever Given ship that blocked the Strait, not the Strait of Hormuz, the Suez Canal.
The Suez Canal, yeah.
The Suez Canal. I mean, nothing happened to oil prices. And that's because nothing fundamental was happening. You can redirect shippings from the Suez Canal to reach other parts of the world. If there were a real destruction of production assets in the Middle East, then that would be something different. And nothing happened also because we have all this growing production from the Americas, which is going to continue being the engine of growth. So anyway, that's a broader story. And no, Mexico will not be adding in any significant way barrels to the market either.
But again, I mean, everybody's talking about the backwardation, but it's a very, very narrow backwardation, and it could flip if we see more supply coming on. I mean, at the moment, OPEC Plus has been very, the 8 members, whereas with their voluntary cuts, they've remained relatively calm. They've held steady, waiting to see what happens. And there's a question now, which I would like to take from somebody, Mark Findlay, who we actually know, says there's been a lot of controversy around oil market outlooks, both short and long term. Most notably, IEA versus OPEC, and we see the EIA is always somewhere in the middle. So, which outlooks do you put more trust in, and why? And do you worry about the analysis becoming more politicized? And how do you make decisions in the face of that? So, who would like to take this one? I mean, Harry, do you want to start off with I'm looking at the numbers, and the IEA says that they see demand growth of 800 and something for this year, 1,000, right? And they see slower demand. They also see a massive surplus of close to 3.7 million barrels for this year, which is quite huge. And OPEC has sort of basically held their outlook steady. They see demand over 1 million. So how do you reconcile this, growing gap? And I know the IEF produces these sort of comparisons of, where the IEA is, where OPEC is. How do you explain this? What are they looking at? I mean, they must be looking at IMF.
I mean, it's again, you have to take each of these organizations for what they are, right, and where they stand. Now, there's been a lot of controversy with OPEC trolling the IEA a little bit for finding a few missing barrels here and there in Africa and then the Middle East. 300 KBD, which is well within the margin of error of this type of data, as we know. That's where a lot of the difference lies, of course, and because, OPEC needs a narrative where oil demand is growing, it is relevant to their purpose, if you will. At the same time, one could look at OPEC's own numbers, in particular the secondary sources that they employ to narrate what's happening with their production, And you and I both know that these secondary sources have been heavily curated over the past couple of years, where certain contributors have been removed, others have been put in. Make of that as you what you will. I just know that by looking at other sources of OPEC production estimates, clearly there are some countries there that are well above their quota and the numbers that typically are circulating. And to be very precise, production in the UAE is definitely well above what most people are quoting. Now, of course, UAE is a contentious issue, and as we know, the Saudis and the Emiratis have had a few differences in past OPEC meetings, and so the finger is not pointed at them. Sadly, it's directed at the Iraqis and the Kurds, so to speak. But to come back to the original question, I think you just have to look at, realistic where these two agencies kind of align. I don't think that they're that much different when it comes to growth outside of OPEC plus countries. Obviously, there are issues in terms of how you assess Russia. Personally, I think that there's downside to Russian production this year because the Indians will start moving away and looking for other barrels. And then on the demand side, one could argue that the IEA has been maybe a little bit too conservative in terms of its projections, or perhaps over enthusiastic when it comes to EV penetration, so as to curb the arch, if you will, of oil demand growth. But I think you just have to look at each of these and see where the most obvious weaknesses are. And once you correct for them, you have a general discourse. So a massive surplus. The IEA has probably the biggest one. OPEC has one. The EIA has one. I think they just moved above 3 million barrels a day, 3.6 in Q2. It's not about that absolute headline number. When we're talking about the implied change in global oil stocks, we have to recognize that there's unaccounted for oil, of course, error in the numbers. But we have to look at the components. Where is that oil going? And the harder the US start putting the noose on sanctioned countries, and just to give you an example, in the last days of the Biden administration, when sanctions were imposed on Russia, what did the Indian West Coast refiners do? All rushed towards Middle Eastern barrels, and we had a big spike in Dubai. So we'll see how it goes in terms of US implementation of sanctions. But at the end of the day, when you look at these forecasts, you sort of have to remember where these people are coming from, which these agencies, what's their starting point. Amend for the weaknesses, and you get a picture that I think is just simply closer to the truth. I'm not going to be here advocating for one or for the other. I take what I believe is best from each one.
Okay. So, I mean, what I remember a very long time ago, I think it might have been 2006, I was talking to a Saudi minister who was minister at the time, I think it was Ali Naimi, and he said, I don't think we will ever be called upon to produce more than 10 million barrels a day. And I think he was right. I mean, that's why people are now saying, we're not talking net zero anymore. It's sort of the narrative has shifted. And I think, Carole, you mentioned when the IEA came out with their World Energy Outlook, the latest one, we had a discussion as to whether it was an about face. Are they now saying, oil demand is going to continue in one of their scenarios? And you said that the narrative has changed. Can you sort of talk us through it? Because we've seen, now Kuwait is going to expand its production capacity. Saudi Arabia is staying as they are, even though the switch to renewables and more gas means that they will have more oil for exports, because they're not going to be burning so much oil for power generation. So where, you've got Iraq now, you've got companies rushing in. I mean, we've seen a lot of interest now, even from the US companies. The Middle East is hot again. So can you, Carole, maybe give us a picture of why the Middle East is back in favor now as a sort of, an upstream destination?
First, Kate, before I answer this question, I want to go back to the question that you asked, Harry. I'm glad that you directed that question to him, because, it can be interpreted in all sorts of ways, but it actually made me think about that despite the fact we have a global market, an industry which is more than a century old, to have these kind of divergences between two important institutions made me think about actually the ongoing lack of transparency in global oil markets. So it's not just, maybe there will be some political agenda to be pursued or some interest to be pursued. We cannot say it's completely objective, but it also highlights the fact that we all engage in some kind of guesswork to a certain level. Some of it is more informed than the other, but we shouldn't forget that. And I think today it's more of a challenge because of the erratic political environment that we are seeing. We're seeing policies suddenly taking everyone by surprise. And you mentioned tariffs, Kate, because it's not just the IEA and OPEC that did not get perhaps the numbers right. Look at other important institutions, the IMF, World Bank, in their economic outlooks. They also revised their forecast because they said actually it wasn't as bad as we thought was going to be, because not all the tariffs that were announced were actually implemented. Only a small share of those that were announced was implemented, and that changed the whole forecast and the outlook for demand. So I wanted to highlight that in terms of data divergence, though I don't know why I have the feeling that this year the gap between the IEA and OPEC is likely to become smaller than what we saw in the last 2 years, or particularly last year. And to go back to your question on net zero and the whole shift in narrative and the IEA reintroducing a scenario that it dished a few years ago about oil and gas demand maintaining their growth and not peaking anytime soon. I have to remind people again and again that these outlooks are not forecasts, they are scenarios. And with scenario, you can cover anything under the sun, right? So you pick the set of assumptions, you pick the set of scenario that you want to develop, and you can come up with anything and then decide which one you want to include in your outlook, depending on the popularity and the overall mood and the political support or not. So all this have to be taken into consideration. That's why for all these scenarios, I will always read them with a big pinch of salt. Now, in terms of the Middle East and expanding production, I don't think the Middle East ever really ditched its plans in terms of production expansion. They may have delayed until the picture becomes clearer, but they have a clear advantage over everybody else. They are the low-cost producer with massive reserves. But beyond those two, so these are the two characteristics that I would look at, even in a greener world, moving more into renewable energy, but oil and gas will continue to play a role in that world. But some of them also have an additional advantage, that is the low carbon intensity. Like Saudi Arabia and the UAE, if you look at Aramco or ADNOC, they keep on reminding us that their oil is not just cheaper to produce, and they have a lot of it, but it also has one of the, if not the lowest carbon intensity in the world. And that by itself can give them another competitive edge in a world where, assuming oil and gas demand is going to start to shrink. Not everybody in the Middle East has that advantage. You mentioned Iraq. Iraq has a very high carbon intensity. And despite its low cost of extraction and its large reserves, it is at a disadvantage because of that reality. So I wouldn't put all Middle Eastern oil and gas producers in the same basket. There are clear divergences, but I wouldn't be surprised if they maintain their investment in expanding their production capacity, because even if today they are facing a lot of competition, I think in the long term it would be fair to say that there will be more reliance, not less reliance, on Middle Eastern oil, though market realities will be different and prices will face a different pressure than what we are seeing today.
Okay, anybody else want to come in on the subject, Aldo?
Sure, I'll just add a little bit. As when this exercise the IEF does with OPEC, the IEF does with OPEC and the IEA to understand energy outlooks. What we've learned from that process is that it's still very difficult, as Carole said, to have market transparency at the level that would allow us to have base year information, which is the one that is used for these projections or forecasts or scenarios that are similar. We still have differences in terms of, we have made significant progress in terms of having the agencies, for example, use the same base year. But some definitions about geography, products, some assumptions about production and the like are different, and they do affect how these projections look. That said, it does appear to me that over the last few years, the IEA was emphasizing a scenario that was more normative, that just based on the fundamentals that we were seeing in the market. The IEA was not only seeing that renewables and clean energies were making were advancing in the energy mix, but was pushing for that to happen much faster. And that seems to have affected the narrative and the shape of the the scenarios and the forecasts that the IA was making. But in general, that again, that said, if you see the central scenarios for OPEC and the IA, they are not that different, despite all the the things that appear to be so hard to reconcile between both types of base analysis that both groups are making. I have great respect for the analysts in both organizations. I think they do very serious work. Not for a second would I suggest that that they are just pushing a political agenda or the like. I mean, it is very legitimate to have different views on how the market might evolve. And well, that's part of the process, right? To be discussing what people are seeing different in the same with the same set of data. I mean,
Yeah, well, they do have their constituents as well. So, that's something that that people who fund these organizations have a say in the programs that are adopted. I mean, the current policy scenario, I think, is the one we're talking about to the IEA.
yeah.
It's a very unrealistic scenario because it assumes that there's going to be no policy changes between now and 2050. And if you look at it's not a forecast, the scenario shows you that we would all by 2021, Earth wouldn't exist anymore. It would be, an inferno. So I think,
Okay.
one has
Can I,
to, yes.
can I jump in?
Please,
Harry
yes.
wants to jump in. Yes.
Please jump in.
There's been a lot of jumping up and down on the IEA and its forecasts, and what I would say is that the current policy scenario that has been brought in should never have been taken out in the first place. And when you look at these long-term forecasts, you have to understand one thing, and I mean, Carole said this perfectly. These are scenarios. So when you have an agenda, and the IEA is pushing for an agenda of net zero, in effect, you're going to work backward from the terminal point to today to see what kind of path will actually allow you to reduce those emissions in line with the objectives. And naturally, it's unsurprising that the director of the IEA comes out with a net zero forecast indicating that we should stop all investment in oil and gas. Now, that is in relation to a scenario, a terminal value, and you work backward to see what path you need to take in terms of the energy mix to actually get there. Once you go back to the current policy scenario, and we know there's a lot of policy uncertainty, we know that not every single policy is going to be enacted, and you look over the next 5 years, and then suddenly the forecasts of the IEA, as Aldo was saying, align a lot closer with those of OPEC because we're assuming different set of circumstances, and so you let the current momentum take you to where it goes. So I think understanding what these forecasts are about, right, is extremely important, that they are scenarios. And in the case of the IEA, people beating upon them for saying, well, oil demand is going to collapse, coal demand is going to collapse, the growth in use of natural gas is going to be stunted, et cetera, all have to be taken within that context of meeting net zero. Once you remove that constraint and you say, well, what could happen under the current policies over the next 5 years? So initially, we had oil demand peaking in the IEA's medium-term forecast in 2029 with a view that you had this net zero agenda. You remove it, and suddenly you have oil that continues to grow, eventually plateau for a very long time before that demand begins to erode. So understanding the nature of these, and a lot of headlines I saw just simply were ignorant of the fact of what kind of exercise this agency or others that produce long-term forecasts are doing. So once you understand what it's about, then you could modulate these scenarios and come up with different outcomes. But at the end of the day, with the return of the current policy scenario, we see not that much difference in terms of the progression of oil demand over the next 5 to 10 years. And that's really the bottom line. So you have to think about as to whether or not governments have the fiscal clout to implement all these net zero policies. Will the political environment be there for elected leaders to follow through, even though some of these policies may be extremely unpopular with with people in their respective countries. Anyway, just to say that it's terribly difficult to do, very subject to your initial assumptions, and that such a long-term forecast, variations at the beginning end up with very large differences at the end.
Yeah, I mean, I think if we want an example of how these forecasts or these scenarios can really be off, is remember BP when they were still doing the statistical review of world energy? They had demand peaking, I think, in 2019 or something.
Earlier, I think,
Yeah, well, that it was, yeah. So I think, but there are obviously certain peaks in demand. I'm sorry that there is a lot of noise here, so I'm going to mute myself and move on to, because I want to talk about LNG, because, if you look at...
Kate, can I just step in just to highlight
of course,
one thing? Because
please, yeah.
we talk about these outlooks as if it's only about the demand, but we also underestimate supply growth, because if you look at the outlook, both from OPEC and the IEA from the beginning of the century and even up to perhaps 2010, hardly anyone mentioned shale in the US. And even when shale revolution started, it was completely dismissed. The IES publication and those scenarios, they completely underestimated the growth of shale, because technology is something that is very, very difficult to model. So we should also understand it's not just about our ability to forecast or build scenarios for demand. We already have a proven track record of our inability to capture technological changes in those scenarios.
Just to add to that equation, the politics of it, if you see the scenarios of 10 years ago, even not as far, 5 years ago, we see that the oil demand begins to flatten sometime around now. And that was because the penetration of EVs would have been faster and stronger. And right now we're seeing that that is exactly not going to be the case, right? With the US basically rolling back some of the incentives for EVs, Europe rethinking the date for when companies will be forced to only sell EVs and the like. So this is one other thing that it's not only very hard to predict how technology will be affecting these developments, but how politics will be shifting in such dramatic ways. And this year has been quite clear or quite representative of that, rather.
Yeah, and also we look at the moment, I want to switch to gas in a moment, but if you look at electricity prices in Europe, they're actually quite high at the moment, which is another discouraging factor. And again, it's all back to China. In China, I think the number of EVs sold are much higher than ICE, internal combustion engines, and that's going to continue. And now they're switching their heavy vehicles as well. But it's what I find interesting is a lot of the investment in new upstream capacity is also to basically we're going to stand still, right, because of natural declines. And if you look at the OPEC Plus, the reason why it's only 8 that we talk about, the 8 who sort of apply the voluntary cuts and increases because they can. They've got the capacity, whereas others don't because they haven't invested. So now we're seeing a return. Libya, for example, is seeing a lot of interest in the upstream, even though I wouldn't call it a stable country. It's still a divided country. There's no talk of elections. There's a lot of heavily armed people. There seems to be a status quo that people are sort of saying now, this is the way it is. And there's a lot of cheap oil. It's very close to markets. But there seems to be a sort of degree of political risk that people are looking at. So it's like, yeah, we'll go into Iraq, negotiating with Iraq, even though we've had elections in Iraq and they still don't have a prime minister. And the person who was nominated, and Maliki, who was nominated for prime minister, is not somebody that Mr. Trump is happy with because he's seen as too close to Iran. So again, the geopolitics playing. But whatever we do now, I mean, if you're going to be investing in upstream now, you've got to be certain that there is going to be demand, because if it's a greenfield investment in upstream, you're talking 5-6 years before that oil or gas is going to come to markets. And if you do believe that demand for oil is going to peak, where do you look? You need to replace some of that lost production capacity, which I think was a big issue. But when it comes to gas, I think the projections are that it will continue, that there will be growth in demand for gas and LNG. It's just now a question of when we see this sort of surge in supply, which is mainly going to come from the United States and from Qatar. And a bit of delay in Qatar, so that's going to, we're now taking it into next year instead of this year, the expansion. And I mean, I don't know why it's taking so long to bring an expansion, because you're not starting from scratch. So you look at Shell, they see a 60% growth in demand up to 2045 for LNG, and they're putting a lot of their eggs in that basket. So what is where do you see the LNG market? I mean, is it still central to energy security? Is it a transition fuel or a destination fuel, which is the sort of the old debate of where it stands in the energy mix? And also structurally, the market has changed since the Russian invasion of Ukraine. We're not getting that much pipeline gas. And again, when we go back to the Strait of Hormuz, a lot of that Qatari LNG, in fact, all of the Qatari LNG goes through the Strait. So any disruption would have, I think, a huge impact. And I don't know if we're going to see the spikes that we saw after the invasion, when the price of LNG on the spot market hit a record. So what is your view of LNG in the global sort of energy landscape as it evolves? Who wants to take this one? Carole.
I was going to ask you who you want to go first. Yeah, but I mean, Kate, I have to disagree with you on one thing, that the LNG market or gas markets did not or have not fundamentally changed after the war in Ukraine.
They have.
Actually,
I said they have.
Before.
I said they have.
And I tell you why. Actually, in 2021, when LNG trade overtook pipeline trade, that is, for me, is a much more important structural change that has happened in gas markets than what followed. Not to underestimate the impact of the fallout with Ukraine, but structurally, that has changed the dynamics of pricing, and the trade of gas actually happened just before that. And if you plot the trade of gas by pipeline and trade by LNG, it was amazing increase from LNG, and largely because of the share revolution in the US that made a big volume of gas available to global markets, which coincided at the same time with an expansion in the number of LNG importers, in addition to an expansion of LNG exporters. And funny enough, if you look at the last 20 years, you can see how everything has exploded in terms of numbers and also in terms of volume trade. And that by itself brings with it different dynamics for pricing, especially as US is involved, because most of the American LNG is sold under short-term contracts or spot pricing, whereas Qataris have the opposite, long-term oil index. But with that kind of change in the market, we expect to see greater volatility in prices. So we don't have anymore with pipeline gas, we used to have a much more contained volatility and rather stable prices over a long period. But today we are seeing this kind of not just seasonality, but changes to sensitivity to political developments, other decisions, policy with respect to energy, green energy, climate change, you name it. So we're seeing this kind of additional volatility in gas markets, and that by itself also will dictate the market dynamics. So anyway, so that's what I wanted to highlight. In terms of going forward, I mean, look, when you look at the LNG supply, more than 60% is concentrated in 3 players, US, Qatar, and Australia. But among these 3, Among the three, the two which have the ability to expand their capacity are the US and Qatar. And funny enough, Russia comes in level number 4, around 8% of global LNG. And it could change if the sanctions are lifted and we love Russia as we used to do in the past. I don't know, we'll see. But the story of LNG expansion capacity seems to be concentrated on the US and Qatar. And there's plenty of gas coming to the market. So there might be some additional pressure on prices in the short term because of seasonality and depending on the market you're looking at. But again, in the next 5 years at least, I see a big wave of additional LNG capacity coming primarily from those two countries, but not only from them. You have other players, new kids on the block in Africa and elsewhere also contributing to that supply.
Well, I mean, if you talk to the CEO of Shell, he'd tell you, well, lower prices mean more demand, but where is this demand going to come from? I mean, who is going to drive this demand?
I think when you look at the various scenarios that are brought out by oil companies when they present their earnings, I mean, you talk about Shell. TotalEnergies is a big believer in gas. They're heavily invested.
And electricity. They're big believers in electricity.
The transition is taking shape in some of the oil and gas majors and who are becoming, and Total changed its name and emphasizing the energies, right? Because eventually they may be more prominent players, in an integrated chain of delivering electricity to the end user. But by the by, the interesting thing, of course, is that when you compare to oil, you have global LNG trade, but we're not talking about a globalized market as in the case of oil, and there are obviously some rigidities there. And more importantly, I think that, as highlighted, the structural changes and, they basically put an end to pipe gas into Europe virtually. And we had a rush for the doors in terms of securing LNG for Europe coming from the US. And US capacity, as mentioned, on the eastern seaboard has grown and will continue to grow. And I think for me, the interesting part is going to be the pricing dynamics between East, West, and what I put in the middle, Europe. Europe is going to be the battleground for dumping LNG, and we're going to see where the price convergences will happen between benchmark like Henry Hub, TTF, or JKM in Asia. The gas growth appears to be there. Sometimes with these kind of energy sources, you want a secure offtake from a client. But as mentioned, the models of long-term contracting for gas that were basically the mainstay 20 years ago or more, that has changed, and there is more spot in the market than there used to be, including in Europe. So all in all, my view is that LNG will start more and more over the next years, and it could take longer, having that globalized, just like oil, type of delivery. And for me, Europe is a sink in which all that LNG has to end up in. So who wins between the Americans and the Asians in delivering this gas? Right now, maybe politically, President Trump is pushing his European allies to take gas from a quote unquote friendly country.
Yeah, I was going to say, sort of LNG has become quite politicized, the China-US relationship, China not buying LNG from the US. I mean, at one point, I think they had a tiff with the Australians. So I think it's become much more politicized. Probably it will become less so as you get this so-called new wave. But I mean, Qatar still has a lot of uncommitted volumes from its expansions, and they're being quite rigid about their contracts and destination clauses and so on. But when it comes to Europe, I mean, there are there new regulations coming in about the carbon content, about the all kinds of new restrictions on what you can export to Europe and what you have to comply with. The list is growing, but I mean, in a way, do we expect this to continue? Like CBAM is, I suppose, there, but are we going to see Europe change its tune a little bit? Because I mean, if they don't get that much from Qatar, but they do get some LNG from the UAE, they get some from Oman, they have Qatar. is it likely that Europe will find itself in a position of being over-reliant on the United States for its supplies of LNG if Qatar goes ahead with its threat to stop selling to Europeans unless they sort of water down some of the new regulations that they've put in place?
Well, I was going to say it could be, but they don't want to, right? Europe is already saying, I mean, flagging already this risk that you're mentioning, the over-reliance on a particular country. So I would expect policy to be shifting in some way. But also I want to connect with some of what you said, Kate, at the beginning of your question about whether gas is a destination, natural gas, a destination fuel or a bridge. I think the way to look at it is that as soon as we're talking about natural gas, we're mainly talking about power markets. And what has changed a lot in electricity markets and electricity generation in the world is the penetration of renewables, particularly solar, and its combination with natural gas. So that they are having a dance together, natural gas and solar energy. And they are in this dance cleaning the power sector and increasing their share in the power sector. That's the one big story of the energy transition that is happening. We now see that solar and natural gas represent a much higher share of the energy mix than they had, say, 20 years ago. So that's where we see some significant shift. Whether it's going to be increasing at the rate that we have seen up to now, it's still up to question. But I think that they will be both continue to grow and represent a significant share of demand. And I don't see any government yet putting all the eggs in the renewable energies basket. And that means that if you want cleaner power generation, you have to think about natural gas. And that's where the LNG market is. And that's one of the reasons why the LNG market is growing so much. It's providing that cleaner energy and more flexibility. And of course, there's other energy sources to talk about, but I think that's part of the equation that is making LNG so relevant.
Well, yes, and we're seeing from the Gulf, we're seeing a lot of investment in energy projects in the United States. We've seen Saudi Arabia and the UAE. They're also, if you look at their investment portfolios within the region, there's a lot of focus on gas production in Saudi Arabia, both unconventional gas, and I'm just wondering, it doesn't really get talked about very much, but I mean, the Gulf they've got this dual track strategy. They are investing in new upstream, a lot of it gas, some countries in oil, but they're also deploying renewables. I mean, in Saudi Arabia, it's really at a very, very fast pace. I think 20 gigawatts a year they're planning. The UAE obviously has, was an early starter, but I think they've been overtaken by Saudi Arabia. I think we're going to get new solar in Iraq soon. I think Kuwait is finally waking up to the fact that they really need to start, moving on that. So we are seeing this. And is it really about decarbonization? We're not seeing too much decarbonization. We're not seeing too many sort of mega CCS projects in the region, even though they're talked about a lot. Or is it about freeing up more oil and gas for export, which will come eventually? Carole, do you have any thoughts on this? I mean, what is the policy direction of these countries? Is it really about, is it a green policy, or is it more about preservation of their role as suppliers of cleaner energy, of all types of energy? Because let's face it, they're not going to get the same amount of rent from renewables. They talk green hydrogen, blue hydrogen, but unless you've got off takers, a lot of it, apart from neon, which is sort of moving forward, we're seeing a lot of slowdown. So your thoughts on that?
Well,
side
you're
of
absolutely
things?
right that they will not get the same rent. And actually, I cannot imagine renewable energy generating any rent near what oil and gas finite resources produce just because they have endless supply when it comes to renewables. So, economically speaking, you cannot generate the same economic rent. But to understand the rationale, it can be both, but it doesn't matter. I mean, they both are for me a win-win situation in the Middle East. But I would say that definitely the economic rationale is much more stronger than the decarbonization rationale, but the decarbonization is coming as an additional benefit. Because when you look at these countries and when you look at their power mix, how it lacks, I think the Middle East stands up, is quite unique in the world. It's the only region in the world that still burns a substantial volume of oil to generate electricity. That is for me is a waste of economic rent because you could use that resource into something much more valuable, and that is like exporting it instead of burning it in power generation, often for a domestic industry where prices are subsidized. So it's additional burden, financial burden on the government. But also the Middle East stands out in terms of the lack of diversification. It's a power mix. It is the least diversified region when it comes to the power mix, and primarily it's oil and gas. And you don't have this kind of this level of concentration anywhere else. So in a sense that if you invest more in renewables wherever it makes sense, either because of the availability of sun or wind, and then, but again, you have to see to what extent the government is subsidizing that expansion of renewable energy. But diversifying the power mix is beneficial both economically and comes with the advantage of reducing your carbon footprint, which is actually important for the region, maybe not necessarily to the people who live in that region, but also it's part of the image that they are creating in the world, that they want to be part of the solution, not the problem. So they can both be an important supplier of oil and gas, but again, they are different than other suppliers because they are conscious about their carbon footprint and they're doing things better at home. So there's also this kind of global image in terms of standing up as being both an oil and gas producer and a climate change conscious producer.
I mean, having lived in Dubai for a long time, I think that that part of the world is overheating much faster than any other part of the world. So that's, there is a case to be made. There's a water issue. A lot goes into desalination. So I think as you switch to reverse osmosis, as you try to use more renewables, you are using less gas. I mean, I think the gas is still overwhelming me, the largest feedstock for power generation in the Middle East. We're seeing a reduction in Saudi Arabia. They're not burning as much oil. I think other countries, I think Kuwait still burns oil and liquid fuels because they have an electricity shortage. So yeah,
Kate,
go ahead.
in terms of probably reinforcing some of the points that Carole made in the Middle East, but in my view, when we look at the trajectory of gas, at the end of the day, the war in Ukraine has highlighted the issues around security of energy supplies, right? And again, what's going on in Iran is highlighting this very same issues of security of supply, which is why China is basically filling up its storage as much as it can. But in the end, other than California and the Middle East, with 365 days of sun, one has to really wonder in terms of security of supply to generate electricity for your citizens. You need some kind of base load demand that is insured, continuous, and not subject to weather changes. So whether that, no pun intended, whether that's the wind or the amount of sun that you get, you have to find a solution. And if you're going to frame this in an energy transition context, then this is where obviously beyond gas, you want nuclear, which poses its own, set of issues when it comes to disposal of waste and so on. But technically, according to the EU, this would constitute a non-emitting source in terms of power generation. And you want that base load. And you need that base load, and your citizens would not understand that the lights go out because simply it's raining. I'm being a little bit facetious, of course, but that is certainly probably meeting the growing needs of electricity demand in the future, whether that's tied to data centers. And I saw an interesting article this morning on the Wall Street Journal that was saying that a lot of energy or electricity generation now being powered by jet jet engines used to generate electricity to power AI centers, if you could believe it. So we're back to oil
Oh,
again.
that's
There's an
interesting.
article in the Wall Street Journal today talking about generating electricity with jet engines for AI and data centers. But anyway, the baseload argument still is one where, in the context of growing electricity demand that everyone has agreed upon, then you're going to need a secure source of electricity, or something that powers that generates that electricity. And it isn't going to be renewables, because you run that risk. And as far as the Middle East, it makes absolutely a lot of sense for those countries that produce electricity based on oil. Well, monetize your underground asset and enjoy the natural advantage you have when it comes to being able to make electricity from renewables. And if that's in addition, that's a great PR stunt for the region, so be it, you know.
We're going to come to AI, I think, in a minute, but it's interesting you mentioned that, because I also saw an article today on the OPEC website, which I sort of occasionally look at because, you get an idea of where their thinking is. And the headline says that oil can help achieve SDG 7, which is Sustainability Development Goal 7 of the UN, which is energy access for all by 2030, which is, quite a short time frame. We still have, 700 million people who don't have access to secure energy. And they're basically saying you need a base load, and that base load has to be, if you have an interruption, generators are what really kick in hospitals, in the sort of strategic parts of the economy, and they're basically diesel. So diesel is going to have a future, because you can't, and the point they're making is you cannot exclude certain fuels if you want energy access for all, people in Africa, in parts of Southeast Asia who don't have access to electricity. So it would be wrong to say you're going to produce, that they can only have renewable energy and take out hydrocarbons. So it's sort of roughly the same thing. But again, a lot of discussion wherever you go these days, any conference, it's either talking about China, geopolitics, or AI and what role that's going to have. And some people say, actually, because of the efficiencies that you will get once it's up and running, then your energy demand isn't going to be that huge, because you will have savings from other parts of the economy. But again, we're seeing revival in nuclear. So to go back to the Gulf, I keep trying to go back to the Gulf because this is the Gulf, the Arab Gulf Institute, is how much investment there is in artificial intelligence, in data centers in that part of the world. So how is that going to change the dynamics of the economies of the region? Are they really becoming, they're investing not only in the region, but abroad as well. I mean, we're seeing recently Kuwait took a stake in Brazil offshore, took part of Shell's stake in pre-salt. We're seeing a lot of investment in LNG by Gulf NOCs. We're seeing them go into partnerships in East Mediterranean and other parts of the world with the majors. So are they becoming sort of investors in their own right, as well as becoming sort of major players in the artificial intelligence sector? And how much clout does that give those Gulf states that have the ability to become sort of strategic investors in new technologies?
But there's three things going on in there, right? It's one thing is investing in data centers, another one in the development of AI itself, and yet another one in developing, and which is associated to the second, a domestic base of programmers, computing experts, and the like, that can develop new technologies. So it's software, hardware, and just the raw data processing. So we have seen announcements mostly about the data processing and the intentions to have ingrown AI and technology development, but we'll have to see more of how that grows. Now, but maybe let me provoke a little bit more the debate just to connect with what we've been discussing. As we were talking, I took the time to check the IEA's 2000 World Energy Outlook and what it would say about today. And that outlook projects, it has scenarios for 2020, so it doesn't get as far as 2025. And what's interesting is that, for example, it suggests that world oil demand would have reached 115 million barrels per day, and that fossil fuels would be 90% of the global energy mix. So in 2020, just before the pandemic, we were some 15 to 12 million barrels per day short of that scenario or of that projection. And fossil fuels were about 75% to 80 of the global energy mix. So there's a good chunk. And that projection was made before the Chinese energy shock, the shale revolution, and well, certainly before AI and the geopolitics that we've seen there. That projection did not assume, and this is why I was reminded of this because of something just said, Kate, did not assume the progress, the technological progress and the efficiency that made possible this demand reduction in demand growth. So we have seen, because of energy efficiency, because of natural gas and because of renewables, a decline in oil demand, of projected oil demand of close to 15 million barrels per day, and that's not negligible. I can only wonder what AI will mean for efficiency and not only consumption of energy as we move forward.
Yeah.
Kate, maybe
Yes.
something a little bit interesting. Aldo, and I don't think in 2000 anyone was talking energy transition and hitting emission targets or anything like that. But
Well, exactly.
your point is well taken though. Technology, and I think Carole also alluded to this or in earlier remarks. It's hard to forecast technological changes, right?
Yeah.
Certainly disruptive ones, as in the case of shale, where these deposits were well known for many, many years, till finally one day they figured out how to frack the rock in a manner that would essentially be economically viable to extract that particular resource. But coming back on the Gulf, it's certainly interesting, and I don't profess to be a specialist in terms of Gulf economies and their future and their strategy, but just as a casual observer, we're obviously looking at a region that is what I'd call, or maybe somebody else has already called, the electricity economy. So here we are talking about AI centers, right? And then data centers. And you could look at the sort of friendliness that you have in the region, in the UAE, relative to crypto. And crypto is all about basically maintaining a blockchain, and that requires electricity. And there you are in this electricity economy. You want to draw capital towards your country, then you start becoming friendly in the areas that you perceive as being the ones that will push future growth. And it's not surprising when you start looking at stock market valuations, which companies, tech companies such as NVIDIA, for example, obviously very tied to data centers and data processing, etc., are at record valuations, and still, those stocks that you want to be probably invested in. Although some will probably disagree with that argument, and I'm not advocating you should buy NVIDIA, but I'm just observing that above and beyond, I think the early days where the likes of Dubai were becoming centers to bring together East and West so you wouldn't have to travel so far, and you'd have infrastructure, conference centers, hotels, you name it, tourism, obviously, that developed. And so what's the next step in diversifying out of your fossil fuel resource base? Then you're looking at in my view anyway, the electricity economy. And you look at basically the UAE and how much they've invested in their productive capacity, in parts, obviously, in relation to the launch of a futures contract on Murban. But you're looking at a country that has taken a certain direction in terms of possibly, and I'm speculating here, not having to be left with stranded assets when the time actually comes where demand for fossil fuels, oil, will begin to decline. But on the other hand, if an electricity economy, when you have abundance of sun on top of that, then that certainly could be an interesting future direction. And if you're friendly to crypto, you're friendly to data centers and AI, then that's where the money's going to go.
Yeah, well, I mean, that's one of the reasons, I suppose, why the UAE has been sort of overproducing and getting away with it, because making hay while the sun shines. But Aldo, to go back, you said you looked at the old IEA Rio, and I did as well when it came out, when the last one came out, and in the latest one showed that demand would rise to 113 million barrels a day by 2050 from around 100 million last year. The last one in 2019 projected oil demand rising to 121 million barrels a day by 2040. So it's sort of, in a way, it shows you the impact of the energy transition over the last 6 years. But we're coming close to the end, so I suppose I have to ask you a sort of final question and get your opinions on this. So, are we sort of entering a period where geopolitics dominates energy again, or is the market still sort of, is it, or will it revert back to fundamentals? And what would you be looking at? I mean, what is the scenario that you think is the most likely one to emerge this year? And I know it's really, really hard because of all the uncertainty. So I really do pity, forecasters and people looking at various scenarios that they're working on now. But where do you stand with respect to all these developments, and what would you be watching for over the next few months? So we'll start with Carole. We started with you, so we'll start again.
Yeah, I was hoping that you don't limit it to the next few months, that you would say for the next 3 years. And just was just saying scenarios and then a few months, oops. Well, if it's only the next few months, nothing much will change compared to what we are watching quite closely now. And that is primarily what will happen on the geopolitical side. And it's not just what is happening immediately with Iran, what can happen between Russia and Ukraine, because that has also massive implications for global energy trade. How the situation can unfold further in Venezuela, still a very big wild card, and elsewhere. You mentioned Libya earlier, but I'm getting more and more questions on Syria. It's really another new, I wouldn't say new player. I mean, there isn't much there, but still the interest of Chevron, who signed just an MOU, I think, recently to explore offshore Syria. So lots of moving parts, but I would say they remain defined by geopolitics. And I would say even longer term, Kate, and I think there was one question from, I think, again, Mark Finley, and he asked a very clever question about the state capitalism. And I say, what I'm watching for, and I'm really interested in, is the growing resource nationalism, the protectionism, the move towards deglobalization. Now, why is it this important? This is relevant for oil and gas, but even more so for mining and the energy transition. Because the current energy, the trade system that we have built around energy, the energy trade, is really dependent on globalization. All these trades happening and the deals happening by different players and different stakeholders, and the joint ventures between stakeholders coming all around the world. What impact are we going to see if we continue with the trend that started maybe last year with this kind of deglobalization? And I would like to say it's not just President Trump and his tariff policies. This has started even long before President Trump came to power. We are moving into that direction, and that by itself can rewrite the rules of the game when it comes to global energy trade. But I'm going to stop here because that is a big topic, but it's just something to think about, not just for the next few months, but for many years to come.
I suppose before I go to the others, I should, read the question again that just came in. Only the second question from the audience, that asking whether we're moving beyond the post-war system of the US and its allies promoting an international system of rules-based democratic private enterprise, more towards something that might be characterized as state capitalism. So what do you think this means for global oil supply, demand, trade, investment? So Carole, you've kind of answered that question. So I'm going to move on to Harry and then to Aldo, and wrap it up.
Well, Kate,
Harry,
yeah, this year, the obvious, obviously, that's a good one. The obvious things that we touched upon around the geopolitics in the Middle East, the outlook for the economy under strain of tariffs or not. There's a lot of things there, but I think the question that Carole, I think, defined quite nicely. It kind of reminds me of a book I read when I was in university by Paul Krugman, then still an economist, and he had written this book called Strategic Trade Policy. And in that book, he basically explained how the normal models of trade and economics just didn't work simply because we had state interventionism. And classic examples of that were airlines, Airbus versus, say, Boeing. None of these companies would be able to do what they do without the backing of their respective governments. And so thinking about state capitalism, well, the Chinese have been extremely good at it. And the reason why they've been producing so many EVs at such lower costs and have such overcapacity is because the state was backing it. Same for semiconductors, same for other sectors of the economy, including solar panels, and of course, rare earths and so on. So is there more state intervention in trade, which then could affect how oil is consumed or energy is consumed? Yeah, I think that's certainly part of the deal. Does that necessarily mean that we completely break down in our trading rules and become purely transactional in a Trump-like fashion for case by case? Probably not. I think there's a lot of entrenched procedures and flows that you may not necessarily remove all of them. However, the importance of state, and this was Krugman had really pointed this out, and I think the book was 1991 when he came up with that. So strategic trade policy, I highly recommend if you ever get a hold of that. And Krugman at his best when he was an economist. And yeah, it's certainly the way Trump is going, I think is eliciting that kind of response. But then again, in 3 years' time, who could guarantee that JD Vance is going to take over or whether the US will flip? I have no idea. And the nature of US foreign policy could just as easily change as it has changed under a second Trump tenure. So it's hard to say that, we have now completely shifted paradigms and it's over and the post-war institutions are just completely irrelevant. Anyway, just a few thoughts.
Yeah. Talking about AI in the Gulf, there's an article in this week's MEES Middle East Economic Survey, as it used to be known, about the AI strains and gains and powering the Gulf's digital future by Christopher Gooding, who I have to admit happens to be my son, but it is very good. So I would advise if we didn't really have a chance to talk about it much. But it is, yeah, I'm sorry. It is a good piece. He knows a lot about it. And of course, Aldo, you've known when he was
Yes.
much younger, but yeah, no, he's becoming quite an expert on sustainability and this kind of stuff. So Aldo, final word. What are you going to be looking at now from your wonderful place in
Well, I
wherever
have
you're
one.
sitting?
I have 1 minute. I guess I can only
That's
say
okay.
yes or something like that. No, but no. Look, it has always been the case for governments. The dictum that energy is too important to be left to the market alone. You may or not agree with the statement, but the fact is that states have always been involved strongly in one way or another with the energy industry. This does not necessarily mean controlling the assets. There's a lot of private ownership around the planet, but the state does direct a lot of incentives and craft policies to shape energy, the way the energy industry works. Um, I think the genie is out of the bottle. I think that whatever shift the US political system has, it is now the case that there is a level of hesitation about the commitment the US has to the rules and norms that were there since 1945, even though they may not have been pristinely respected, and there were deviations and the like. So we're in a new world. That has been the emphasis all this year. We certainly heard that from Munich, and that means we're also seeing the statements that Europe is going to be investing much more and crafting policies to reduce dependence from not only the US, from the rest of the planet. In that sense, it's a little bit like the 1970s. It's not that type of oil shock, but it's a recognition that geopolitics has changed the equation. And I think that will be playing out elsewhere as well.
Yeah.
So yes, I think Mark Finley, in asking the question, also was telling us, hey, that you should be paying attention to this. This is actually a new development, and this is going to be conditioning how oil markets develop and energy markets in the coming years.
Yeah, I think it's basically, in short, it's fragmentation. We're not seeing this. We're seeing fragmentation along geopolitical lines, along geographic lines. And that's affecting trade flows, and it's affecting policies, and it's a ship, and it's going to be very difficult to sort of reverse some of these changes. So I think we're going to be living with this uncertainty and these sort of ups and downs for a while. I want to thank you all, and we could have gone on and talked about other things. We didn't talk about critical minerals, but I think we've had enough about critical minerals from other conferences that we all attend. And so thank you very much for taking the time, and I hope to see you at one of our meetings soon. And I shall probably be in Washington I think we're talking about June for the petrodiplomacy. So we'll keep you posted.